Imagine a game where on average you make money every time you play. It sounds like a guaranteed win, a positive expectation, a mathematical edge, a strategy that should work over time. But here's is the problem. Most people don't experience the average. They experience a single path. Expected value is one of the most fundamental ideas in probability. It's simply the weighted average of all possible outcomes, where each outcome is multiplied by its probability. Mathematically, it tells you what you would earn if you could repeat the same experiment over and over again, infinitely many times. But real life doesn't work like that. You don't get infinite repetitions. You don't get perfect averaging. You get one sequence of outcomes, one realization of randomness, one path through time. And that path can look very different from the expected value, especially in the short run or with a limited amount of paths. To see this, imagine a simple game. You win $1 with high probability, but occasionally you lose a large amount. On paper, the expected value might still be positive. The math says you should win, but if you play only a few times, there's a real chance you experience mostly losses, or even go completely broke. This is the gap between expectation and reality. Expected value describes the center of a distribution, but your actual experience comes from a single draw within that distribution. And depending on the variance, that draw can land far away from the expected value. Over time, something interesting happens though. As the numbers of trials increases, outcomes begins to stabilize. The average result starts to converge towards the expected value. This is known as the law of large numbers. But the key word here is large. Converge takes time, and often more time than people expect. In trading and investing, this distinction is critical. A strategy can have a positive expected return, yet still produce long sequences of losses. Without understanding this, it's really easy to abandon a good strategy, or worse, double down on a bad one that just got lucky. So, expected value isn't a guarantee, it's a long-term tendency. It tells you where things are heading, not what will happen next. And if you want to think like a quant, you have to stop asking what's the average and start asking what paths are possible. Because in the real world, you don't live in the average, you live in the path.